I want you to think about your life insurance policy for just a second. Not the death benefit, not the thing that pays out when you're gone. I'm talking about whether you have a policy that's been building cash value while you've been paying premiums for years. Most people who have permanent life insurance, whole life, universal life, indexed universal life, have no idea there's a second asset sitting inside that policy, something they could actually borrow against tax-free while they're alive. Not someday, right now. I'm Jeff Roma, owner of CAE Real Estate Investments. And today's topic might be the single most misunderstood financial tool I talk about. Because most people only think of life insurance as something that pays out when you die, when in some cases it's quietly building a living, breathing asset the whole time. So here's how it works. Permanent life insurance policies, not term life, that's different. Split your premium into two buckets. Part of it covers the cost of the death benefit. Part of it goes into a cash value account that grows over time, either at a fixed rate, tied to an index, or through dividends depending on the policy type. The cash value isn't locked away until you die. You can take a policy loan against it, generally tax-free, without going through underwriting, without a credit check, often same week access to the funds. People have had a policy for 10, 15, 20 years, or sometimes sitting on six figures of cash value they've never touched. Think about what that means. If you took a loan against that cash value and deployed it into an investment generating a return higher than the policy's loan interest rate, and many policy loan rates are fixed and historically very reasonable, you're essentially using money that's already yours, that you've already paid in, to generate a second stream of return, while the policy itself often keeps growing in the background because the loan is against the cash value, not a withdrawal from it. This is the strategy private banking has used for decades. It's not new. It's just never been explained to most people because most insurance agents are trained to sell policies, not to teach people how to use the asset inside the policy. And this is exactly where I need you to slow down, because this is the tool I see misused more than almost anything else I talk about. A policy loan isn't free money. It accrues interest. If that interest compounds and you're not managing it, meaning you're not paying it down or at least covering the interest payments, the loan balance can grow faster than the cash value itself. If that happens, the policy can lapse. And here's the part of that devastates people. If the policy lapses with an outstanding loan, you don't just lose the death benefit. You can also trigger a taxable event on the gain inside the policy, even though you never received cash in hand for that gain. People have lost both their life insurance protection and gotten hit with a tax bill in the same event. There's also a timing issue. Not every policy has meaningful cash value early on. The first several years of the policy, especially whole life, are often weighted towards fees and the cost of insurance, with cash value building slowly at first and accelerating later. If your policy is newer, this strategy might not be available to you at a meaningful scale, no matter how much you've paid in premiums. And this requires coordination between three people who don't normally talk to each other: your insurance carrier, who services the loan, your financial or tax advisor, who should be tracking the loan balance against the cash value, and whoever you're deploying that capital with on the investment side. If those three are operating independently with no one watching the whole picture, that's exactly when a policy quietly lapses and nobody notices until the carrier sends a notice that it's too late to act on. This is genuinely one of the most powerful tools available, and one of the most dangerous if it's managed casually. The difference between these two outcomes isn't the tool itself, it's whether somebody is actually monitoring the loan balance, the policy's performance, and the timeline of the investment it's funding together as one picture. When we talk to investors who are considering this path, the first conversation isn't about our deal. It's about whether they understand their policy. What's the loan interest? What's the current cash value? Is the policy in a stage where it can support this? We'd rather have that conversation up front than have somebody deploy capital into our deal and lose their life insurance policy as a side effect 18 months later. If you've got a permanent life insurance policy and you've genuinely never had anyone explain whether it's holding cash value you could use, comment policy below and I'll send you the guide on how this works and what to check on your policy before doing anything. This one requires care, but used carefully, it's one of the best kept tools in the entire playbook.